In December 2020, BlackRock CEO Laurence Fink remarked that climate change would become a defining factor in the decision making process of investments. Asset manager BlackRock went on to update its guidelines and global principles to reflect its commitment to diversity and climate. At the same time, a consortium of asset managers that were managing $9 trillion dollars in assets under management, also known as AUM, had committed to a goal of net zero greenhouse gas emissions by 2050. Now, why was this happening? It seemed like environmental, social, and governance investing, also called ESG, had gained traction as an alternative approach to allocating capital. Unlike traditional investing, which primarily focuses on financial returns, ESG returns are set to integrate a broader set of considerations into investment decisions. ESG is set to prioritize environmental sustainability, social responsibility, and ethical governance alongside profitability. And what's going on with finance giants like BlackRock, Vanguard, and State Street? They have been known for their robust support of ESG initiatives in recent years. But now, it seems like they may be changing their approach. It may be that money managers are abandoning ESG products in the US, according to Morningstar data. In September 2023, BlackRock was said to have told US regulators that it intended to close some sustainable emerging market bond funds with combined assets worth about $55 million. dollars. A bond fund is a pooled investment vehicle that usually invests in bond with the goal of generating monthly income for investors. These bonds are specifically related to emerging markets, and these funds are set to focus on sustainable investments. Entities like State Street, Columbia Threadneedle, Janus Henderson, and Hartford funds are said to have closed down more than 2 dozen ESG funds this year. It is said that more US sustainable funds had ceased operations in 2023 than in the past 3 years combined. More investors were said to have withdrawn money from these funds in H1 2023 than they invested. The Vanguard Group is said to have reported a significant drop in its approval rate for environmental and social resolutions. In 2023, it was said to fall from 12% in the previous year to 2%. As of June 2023, it was said that the US had close to 660 sustainable funds, but there were more liquidations compared to previous years. Liquidation is about selling off assets and using the proceeds to pay off creditors and shareholders. So, what's going on? The reconsideration of ESG commitments of financial giants doesn't seem to be happening in isolation. State level financial authorities in the US are said to have started to question whether investment strategies should be closely tied to environmental, social, and governance criteria. So maybe the shifts appear to be driven by a combination of public backlash and a renewed focus on financial bottom lines. In January 2023, BlackRock CEO Laurence Fink stated that the asset manager had lost around $4 billion dollars in assets under management. He owed this to a political backlash against ESG in the US. And Laurence Fink stopped using the term ESG recently, saying that it had been weaponized for political gain. It seems like in the US, there has been some anti ESG sentiment. Ronald DeSantis is the current governor of Florida, and he's running for US president for the 2024 election. In March 2023, he is said to have formed an alliance with 18 other US states to protest against a new government rule allowing climate aligned funds in 401k retirement plans. In the US, a 401 retirement plan is a type of employer sponsored retirement savings account allowing employees to save and invest some of their income for retirement. In May 2023, in the US state of Florida, a bill was set to be approved banning state and local governments from using ESG criteria when selling debt or investing public money. In the US, regulator SEC, which is the Securities and Exchange Commission, is said to have made a rule that 80% of a fund's portfolio be assets emblematic of the fund's name. So, if a fund has a specific name like ESG fund, at least 80% of what the fund invests in must actually match what the name suggests. This is because it was believed that some ESG funds were charging investors extra fees and saying they were doing special ESG management. But in reality, they were just investing like regular funds that were charging lower fees. And ESG funds may also be closing because it's believed that 3 years post launch is a common time frame to shut down a fund that doesn't have great investor reception. In Q2 2023, global sustainable funds were said to have attracted about $18 billion of net new money. So, $18 billion was the amount of new investments that flowed into these funds after accounting for withdrawals or redemptions. In the quarter prior, global sustainable funds were said to attract about $31 billion. It is said that when the growth of global sustainable funds is looked at, it seems like their growth rate slowed down. Global sustainable funds were said to have their organic growth rate decline from 1.2% to 0.7% in the same time period. These funds didn't grow as fast as they did before, seemingly, but this may signal a growing demand for ESG investments beyond US borders. Is it at all possible that the commitment to ESG was ever rooted in ideology? Or was it simply a response to market demand? BlackRock, which had launched ESG funds to help decarbonize the economy, seemed to have then changed its stance. It had suggested a short-term increase in fossil fuel output as necessary. Also, in May 2022, BlackRock stated that it would not support a majority of shareholder resolutions on climate change. Why? Because the resolutions were not seen as consistent with their clients' long-term financial interests. According to a report between June 2022 and June 2023, it is said that the firm voted in favor of only 7% of such proposals. This is a drop from the previous years when it backed 22% and 47% of them. So, is all of this just a US issue? What is the future of ESG in the US?